Hello investors, happy Tuesday, and congratulations to the Kansas City Royals, World Series champions, our own Kansas City Royals. We'll claim them since they train here in Surprise, Arizona. I'm Adam Carlini, with me is Grant Haddon. Behind the camera is Gary Luna, also part of our team, and we are Dynamic Wealth Management, your one-stop shop for all your financial needs. Today we will be going over our update of the markets for Tuesday, November 3rd.
Yeah, thanks for being with us this morning. We're excited to do this video. The market has had a few strong weeks in a row, and it just keeps on going up. So we're going to jump into things and show you why. All right, thank you for being with us this morning. We're going to start with some upcoming events that we have. We have an investments for breakfast meeting every other Tuesday in our office. We actually just had one this morning. So our next meeting will be November 17th. 2015. That's at 9 o'clock a.m. We have some breakfast here in our conference room. Anyone's welcome to come. Please come see us. Also in the festival area, we do a seminar out there. This will be a morning seminar at 9 o'clock a.m. We'll have some breakfast there as well. And then on the 19th, we're going to do a dinner seminar in Sun City Grand. If you can come to any of these events, please call us here and reserve your seat. We hope to see you there. Here is our risk indicator. We have been in the green bullish zone for the last 5 weeks. We have some cushion now actually, so if the market turns and falls here, it'll be a little bit of a drop before we get back into the yellow zone. So we like that. We like that over the last 5 weeks things have moved our way and we've made some money, but what that means is that there's potential to come back down as well, so we'll keep a close eye on that. A couple key economic events that show you why the market has moved up a little bit as of late. Here is the core price index. This is tightly correlated to inflation. The Fed likes to see inflation right at about 2%. It's coming in beneath 1.5 at this point, and so they really want to see this move back up before they're comfortable raising rates. So this tells the market rates probably will not be risen this year or even into early next year, which gives them confidence to buy and keep things moving our way. Bad news has been good news as of lately. GDP, more bad news. They expected GDP to come in at 1.7. It came in at 1.5 most recently, which was under the expectation, and it has been on a continuous decline since 2011. So as GDP has continued to go down, the market has ran up because of Fed and stimulus. And that's still the idea out there today. More bad news is good news, meaning that the Fed will not raise rates and might even start to stimulate. How did that affect the stock market? Well, we'll turn some time over to Adam and let him show us.
All right, so looking at the stock market this last week and where we've been, you can see from our chart that for most of the year we were moving in a sideways pattern until that big plunge in August, which found support, tried to rally, failed, but found support again. And since that time, we've been in a pretty strong upward moving market. It got past this level that had been previous resistance. It found support there, got through the next level, couldn't quite get through there, but again consolidated for a couple of days, broke through, and we're now here near all-time highs. So there's a good chance that because we had resistance there 3 times before, that we're going to have resistance here again. That's what we'll be watching for. So the market still has a little upside here before it runs into resistance, but we would expect some pretty strong resistance at this level. However, we're also expecting that if it does pull back, it would find some support in this level right here. It's got quite a bit that it could come down and still be in a bullish phase. So as Grant mentioned before, we're still in that yellow zone, or still in the green zone with quite a bit of buffer till we hit that yellow zone. Looking at this last week, the FOMC meeting where they decided to keep interest rates the same was quite a volatile day. Market started the day up, plunged once they announced that they weren't going to do anything with interest rates, which was fully expected, but was able to find support and continue the rally. Effectively at this point, the market is saying, where else can you go with your money? Interest rates are going to stay down, as Grant talked about, and so even though the economy seems to be weakening and inflation is not an issue, the market is the place where money is flowing. And that's what our model tells us. It tells us where to go, where the money's flowing. Again, this is our core ETF model. It's not all of our models. It can be applied to variable annuities if you have variable annuity accounts. and we use it for our managed accounts. What does this mean for the model? Well, our model allocations, as we mentioned, are still in the green. We're above this yellow line, and as long as we're above that yellow line, we're not neutral. We'll be bullish, and that's where we are. We have been in that area now for 1, 2, 3, 4, starting our 5th week. So that's a nice positive move there. We did just break through the top of this red bar, so there's a possibility that we could hit these all-time highs from here before things start to get a little more dicey and try to consolidate. What that means is we're in the green bullish zone. For those in the core ETF model, which is divided into 3 different categories: growth, moderate, and conservative. If you're in the growth, it means you're 100% invested. If you're in the moderate, you're 80% in equities, 20% in bonds and cash. If you're conservative, you're 60% in equities, 40% bonds and cash. The whole idea behind this is once we cross over those different lines in the sand, we become more defensive. So we would go to the neutral zone and become more defensive and potentially 100% cash. But we're a ways away from that right now, and the market right now is telling us to stay in the green zone, stay invested. Thank you for joining us. We look forward to seeing you and sharing our views again with you at our next installment 2 weeks from now, or 1 week from now, and look forward to seeing you at our Breakfast Club meetings and seminars as well.